integrated problem, which looks at some of the issues that we talked about last week, in particular with respect to property, plant, and equipment. And then we're going to proceed with the materials for units 8, 9, and 10. Now, there's a lot of slides for those units, especially for Unit 9, so I'm not sure if we're going to get through all of it, but let's try our best. So in terms of the integrated problem, hopefully you can see the screen in front of you. This one here is really designed to wrap up all of the major learning outcomes in Unit 7. So in particular, we're here to look at how do we classify PPE, how do we explain and account for PPE, both in the inception and also throughout the duration, and what do we do with respect to borrowing costs. So let's get started. So this problem is really has been adapted from the activity 7.1, which is in front of you. And so usually what I do is I would read the questions first. And so if we look at both task A, B, and C. So task A, determine the carrying value of the machine. Task B is to prepare some journal entries in relation to the machine, but with respect to the next year. And then part C looks at determining the depreciation expense for the year ended 20x6. So in particular, I would stress that paying attention to dates is going to be important. And you can see that this is clearly a problem that goes through multiple time dimensions. Okay, so when we read the question, we need to be aware of this time component. So let's have a look what exactly we're here to do. So you work for a company, say it's A Limited, and they have decided to purchase a new machine, okay? And again, dates are going to be important. The machine was purchased on the 1st of November. The contract value is 12 million with the following components. So 10% on the signing of the contract, 40% to be paid in 6 months, 40% on delivery, and then 10% 2 months after delivery. We are told that the machine is also going to be financed through a bank loan. The terms of the loan, 12 million over 5 years at an interest rate of 7.5%, okay? And then just goes through and talks about some of the conditions for the loan. So it goes as the funds from the bank loan are not all required immediately. They've established an investment account with the same bank for the surplus funds. Okay, so we've got some additional information, a 30 June year end, a revaluation method, okay, to account for PP&E, the useful life of 10 years, residual value of 500,000, formal revaluations undertaken every 3 years. When the assets are revalued, accumulated depreciation is offset against the value of the asset. Procurement, the procurement time of the manager's salary was estimated as 30,000. An additional 125,000 was expended for installation. Some employees had to undergo training. Machine was delivered on the February X4. There was a delivery charge of 250,000. Now into some specific information that relates to task B. We are told that 30 June X5, the machine is operating successfully. So no changes in any residual values or the useful life. However, it was determined that at the end of X5, the fair value of the machine was estimated at 11.5 million. with a remaining useful life of 8 years and 7 months. We are told that the tax treatment of the plant is going to be the same as accounting purposes. For tax purposes, the machine is depreciated over 10 years. Okay, so it's some sort of straight line over 10 years, a tax rate of 30%. So again, this is a pretty involved question. You can see there's multiple components, and so let's jump into each of these. So in terms of the first step, I mean, clearly we need to divide this through sort of one step at a time. And so if we just focus on task A, which is really requiring us to just focus on what is the carrying amount of the machine as at X 2000 X4. And so step one is always going to be about, well, what are the main rules and concepts that are required? Okay, so given that this is PP&E, I've just listed here some of the areas that you need to think about. So for example, what item of PPE are we dealing with? So clearly we're dealing with a machine. We need to think about the carry amount, the depreciation amount, the depreciation method, what is the cost of the asset, and then are there any costs that we can capitalize? Okay, and obviously there's going to be that borrowing cost component. So that's broadly what we need to think about. Okay, so what is the asset, and what should we include as the cost? So if we look at the step two, which is to think about, okay, well, how do we determine the cost of the machine? We need to go back and make reference to the standard, right? So the standard itself pretty much said that anything that was the contract price would be included along with any costs that was necessary in order to prepare the asset so that it would be ready for use and for delivery. And so the value of the contract is 12 million. Okay, so that's going to be one component from the question. We've got some additional site costs. Okay, so this is going to be related to the directly attributable cost. Okay, so that's so getting the machine ready for installation. We've got delivery. So again, that as part of the attributable costs, that's going to be included. And then we need to think about some capitalized interest. Okay, so we know that the company took out a bank loan, right? And so what do we need to think when we calculate interest on a bank loan? So clearly we need to know, what was the loan amount? So again, from the question, we were told that the loan was for 12 million. There was an interest rate of 7.5%. Okay, and in terms of the duration, well, we were told that information in the question. So the first payment on the contract was made on the 1st of November. Okay, the asset itself took a substantial period of time to be ready for its intended use, and therefore it would have satisfied the definition of a qualifying asset, and the machine would have been ready by the 31st of January 2000 X4. And so here you can see that the total duration is going to be 15 months. Okay, and so you can see that initially the capitalized interest on the loan is going to be this amount. But at the same time, we also need to consider for the fact that not all of the funds would have been required, right? So we know that there were a number of these installment payments. And so what this calculation does is it breaks down what were the components of the loan that were not used by the firm. And these were the amounts that was earning interest income, okay, onto this interest income on the investment account. And so you can see that there was a component here, okay, for an initial duration of 6 months. And then you can see there's a secondary component here as well. okay, which is going to be for that 9-month period. Okay, so again, all of the information is given in the question. Okay, so you can see that the fact that we have these adjustments are simply to illustrate the fact that not all of the funds will be needed immediately. So again, where is this information found? Okay, so we can see that so the value of the contract is 12 million, but we pay 10% on the signing of the contract, and then 40% in 6 months, and then 40% on delivery. And so that is going to be what has been incorporated in this note here. Now, what about the staff training costs? Okay, so we're also told that staff were trained. However, the standard makes it quite clear, so did our slides, that training costs cannot be included as part of the cost of the machine. And so when we put this all together, we get here the cost of the machine, which comes down to 13,005,000. So then, once we have the cost, we need to think about the depreciation, right? So this becomes quite a straightforward exercise. So you get the cost of the machine, which was calculated in the earlier step. You think about a residual value, and that was given by the question as being 500,000. So that means that the depreciable amount is going to be the cost less that residual value, and we were told that there was going to be a useful life of 10 years. So the depreciation expense per year is going to be around 1,250,500. However, again, this is why you also need to be careful about the time component, is that the depreciation expense for the financial year 30 June X4, we have to make, we need to apportion that amount, because the asset was ready from the 1st of February or the end of January, which means that only 5 months of the entire year was actually going to be depreciated. And that's how we arrived at this $521,042 here. And so when we combine everything together, we can see that the carrying amount of the machine is just going to be the cost, okay, which was calculated in step 2, minus this accumulated depreciation, and we're left with 12,483,958. Okay, so then if we have a look at task B, okay, which requires us to complete the journal entries for the next year. Okay, so from X4 to X5. So we are told that the company uses the revaluation method, okay, and by doing so, we need to think about what information we need. So what is the fair value? What is the tax rate? And a lot of that has been supplied by the question itself. So if we think about the journal entries that we need in order to follow this revaluation method, first of all, we need to calculate what is the depreciation expense. Okay, so this depreciation amount, which is the 1,250,500, this is what we calculated in our earlier step, so back in task A. Okay, so this is where this amount comes from. And so we need to recognize the depreciation expense for the X5 year first. Now, with respect to the revaluation method, okay, going through the 4 steps, which was in our slide pack last week, the first step when we think about using the revaluation method is that we need to think about the need to rewrite all of the accumulated depreciation to date. And so given that we started accumulating depreciation at the prior year, and we're now into the next year, you can see that this total amount becomes 1.7 million. Okay, so the 521 is the prior year, the 1,250,000, that is the current year. Okay, so we need a journal entry that reverses all of the accumulated depreciation to date. And so what we're left with is, well, what is the carrying amount of the asset versus what it needs to be based on its new fair value. And so the carrying amount of the asset, once we netted out the depreciation, is 11,233,500, and we're told that there's a fair value adjustment of 11.5 million. Okay, so in fact, the asset has gone up. Right? So we need to think about, well, what is going to be the journal entry with respect to the increment. Right? So we know that the asset goes up. We need to recognize a revaluation surplus. We also need to take into account the impact of tax. And so when we look at the next step, okay, which brings that all together, you can see that this is where we are from an accounting perspective. Okay, so this is our accounting calculations for both for the depreciation and for the various carrying amounts. Now, we know that in order to recognize tax effects, we need to work out the tax base for the machine. And so alongside the accounting depreciation, we need to work out, well, what is the tax depreciation? And so from a tax perspective, you can see that the amounts are going to be slightly higher. And the reason why the amounts are higher is that we were told that we don't need to worry about a residual amount for tax purposes. And so the impact of that has meant that as at the X4 year, or at the prior year, we have accumulated this taxable temporary difference. And at the X5 year, we have accumulated a bigger difference, okay? And so when we think about the impact of deferred taxes, we can see that between the X4 year and the X5 year, that there was a movement, right? There was a movement around 15,000. But in terms of the total balance of deferred taxes, okay, we also need to consider the impact on the revaluation, right? So from the revaluation perspective, we can see that the machine has actually gone up in value from 11,233,000 to 11.5 million. And so that difference between the two, which is around 266,500, okay, 30% of that reflects the deferred tax asset that has that was the result of the revaluation, okay? And so on a combined basis, we're left with this amount here, which is 101,212 for the total amount of DTLs. And so if we put everything together, okay, what we find is step one, okay, for the journal entry, we need to recognize the current year depreciation expense, okay. Step two, which is now going into the revaluation method, is that we need to write back the depreciation, okay. Step three, recognize the revaluation increment, okay, so the difference between these two. And in here you can see that this is where the 79,000 has come from. And then step four is to recognize the difference in the change in the DTL balance that existed because of differences in accounting and tax depreciation. And so you can see that these set of journal entries effectively cover all of this prior information. And then going into task C, which is simply to say that, well, now we are in 30 June X6, what should be our new depreciation amount? And so we are told that because we revalued the asset up in the prior year, we need to start off with this value of machine, which is 11.5 million. We then reduce the residual value, which is 500,000, and we're left with this depreciable amount, which is 11 million. And we were also told that the useful life is now 8 years and 7 months. And so when we break all of that together, okay, so this is the depreciable amount divided by the useful life, okay, converted into months, and then multiplied by 12 months for the current year, and we're left with this amount. And so again, you can see that this is, it's quite a comprehensive problem. It will seem quite overwhelming when you do it all at once. And so having the idea of breaking it up into components, in this case, the problem is broken up into time. Okay, so X4, X5, and X6, and then follow each step will pretty much be one of the best ways that you approach something like this. So with that, that concludes our integrated activity. Again, I hope you can see some of the major steps required and how we went through taking you through each of these sort of major components. Happy to take any questions before we jump into the next part of our materials. Yeah, I see that Tracy, do you want to ask a question, Tracy? Let me just, I think I have just unmuted you. Do you have a question? Hi.
Hi, I just have a question on step 4. So on step 4, you're calculating the carrying amount of the machine. So why we don't need to deduct the residual value?
You mean, is this
step 4, this question on step 4?
So here, prepare the journal entry for the revaluation, is that?
Oh, that is the task 8.
Oh, right, okay.
Sorry.
Okay, so step 4. So we have deducted the residual value. So if you look at the cost of the machine was determined to be 13,005,000.
Yeah.
We were told that there was a residual value, which is 500,000. Okay.
Yeah.
So we need to deduct the residual value from the cost of the machine, and we are left with the depreciable amount. So this is the amount that we need to depreciate over the useful life, which is 10 years. So this number, 12.5 million divided by 10 years will give us 1.25 million. Okay.
Yeah.
But because the asset was ready for use only from February, what it means is that for the financial year X4, we only need to recognize 5 months of this. So 1.2 million is the expense over the year or over 12 months. But we only need to recognize 5 months of that because the asset was only ready in the second half of the year or the 1st of February. And so here you can see that the carrying amount is going to be the cost of the machine less the accumulated depreciation, but our accumulated depreciation number has already taken into account of the residual value. So we have taken into account those residual values.
So is that basically the residual value is deducted for the first financial year, first year?
So this residual value, we need to calculate this depreciable amount, right?
Yeah.
So the amount here, which is this 12,505,000, this is the number that we need to allocate as depreciation, right? And so another question is that I just saw on the chat is, if it was a second year, then what would have been deducted as accumulated depreciation? And so this depreciation expense per year, so this number, which is 1250500, is the depreciation amount for each year.
Yeah. Okay.
Okay.
Yeah. I got it.
Yeah.
Thank you.
Yeah, no worries. Look, I mean, that's a fantastic question. So again, just on task A, this is going to be the depreciation amount. Yeah, I've got another hand that was raised. Binon?
Hi, can you hear me?
Yes.
Yeah. Can you just highlight once again for the revaluation part? I'm just not sure because I went through the question and I'm just baffled myself. So if you can just highlight.
Yeah, sure. So what we need to do is we need to determine when the revaluation has taken place. Okay, so that's going to be our first step. So if we just go back to the question, we are told that as at 30 June X5, okay, so this is in the X5 year or the next financial year, the fair value of the machine is 1,500,000. Okay, so this is the fair value.
Yeah.
But what is the carrying amount? Okay, or what is the accounting value or the carrying amount as at the X5 year? Okay, so that is what we need to work out. So how we do this, okay, is that we already know that the carrying amount at the end of the first year is this 12,483,958. Okay, so we know that this amount, hopefully you can see, this amount here, that's going to be the amount at the end of X4 from an accounting perspective.
Yes.
So the amount at the end of X5 is going to be this amount here, but less another year's worth of depreciation. Okay, so we calculate that this is the depreciation for the entire year. Now the machine was operating for the entire year in X5, right?
Yes.
Yeah, and so we deduct this depreciation expense from this number to work out what is our carrying value as at X5. So if we do that, you can see that.
Yeah, I got it now. Yeah.
Yeah, this is going to be the number.
Yeah.
Here.
But then the valuation has gone up. Yeah.
And the valuation has gone up. That's right. And so that's why the first step here is we have to think about what is the direction of the change in the asset. Has it gone up or has it gone down? Okay. So in this particular case, it has gone up. So we know that as a result, we need to recognize this revaluation surplus, right?
Yep.
Yeah, and that's it. Okay.
Okay. Thank you. I got it now.
All right. Awesome. That's excellent. So again, this is a great question. So there was another question. So with interest, when capex or expense? So with the interest expense, recall from last week's notes that we capitalize the interest expense when we have a qualifying asset. So a qualifying asset is defined as an asset that takes a substantial period, that takes more than 12 months to be ready for use, okay? And so in this particular example, we are told that the asset is only going to be ready for use for a period that was more than 12 months. So if the asset is not a qualifying asset, so in other words, if it doesn't take a substantial amount of time to get ready for use, then that interest cannot be capitalized and needs to be expensed. And so that is going to be an answer to that question there. So again, I mean, these are all great questions. Okay, so these are all very, very good questions. So, but this is a very hard example. Okay, I mean, there was a lot of moving parts to this, and so I don't anticipate you'll get something quite as hard as this in the exam. But if you can do these very hard questions, then obviously you're going to have a much easier time doing the more straightforward ones. So with that, I'm going to just switch. Can you see this screen now? Units 8 to 10. I've just switched, but I don't know if, can you see that? Okay, great. So in terms of the materials here, I'm going to take a departure from what I would normally do, which is I want to go through Unit 8, which covers intangible assets, and then to talk about impairment.